You know, in the world of finance, some things just feel permanent, rock solid. For decades, one of those things was the annual letter from Warren Buffett. But that's all about to change. So let's get into it and figure out what this silence really means for the future of investing.
Think about it. For more than half a century, there was this one document that was pretty much required reading for anybody serious about money: the Berkshire Hathaway Annual Letter. It was a masterclass not just in business, but in life. And now, poof, for the first time in 60 years, nothing. So the question is, why now? And maybe more importantly, what's about to rush in and fill that void?
And this isn't just some rumor. Investopedia is reporting on it. This isn't just a missed deadline. It is truly the end of an era. The Oracle of Omaha is officially stepping back, and he's leaving behind a void that, well, generations of investors have never had to deal with before. This is a huge symbolic moment, a signal that we are moving out of one age of investing and into another one that looks completely different.
Okay, so to really get why this is such a big deal, we need to understand why that letter was so important in the first place. It was basically the Bible for an entire philosophy: value investing. And this philosophy, it was all built on patience, on discipline, and on really truly understanding a business from the inside out.
This quote right here, this is Buffett in a nutshell. It gets right to the heart of everything. See, this isn't about chasing hot trends or getting swept up in the latest hype. It's about the difference between owning a piece of a business and just gambling on stock tickers. This simple idea, focusing on quality over pure speculation, well, it created unbelievable lasting wealth for the last 60 years.
So let's just break down the core pillars of his strategy. First, you have to think long-term. We're talking years, decades, not days or weeks. Second, and this is crucial, you absolutely have to understand the business you're buying. Then you learn to ignore all the market noise and just focus on what a company is actually worth. You always build in a margin of safety just in case you got something wrong. And maybe most importantly, you have to be patient and disciplined. For decades, these have been the bedrock rules of finance. But that bedrock is starting to crack.
Right, so as the old guard goes quiet, a new voice is getting louder. And I mean a lot louder. It's faster, and it's completely rewriting the rulebook. Welcome to the age of fintech, where technology isn't just a tool you use for investing anymore. In many ways, it is the market.
And this brings us to a really fascinating concept, a term I first heard on the Investopedia podcast, the vibe economy. This is a world where the story, the social media buzz, the vibe around an asset can make its price explode no matter what the financial statements say. Just think about a stock that becomes a meme on Reddit and its price shoots up 1,000% overnight. That's not happening because of a great earnings report. It's happening because of collective belief and pure momentum. It's a totally new way of thinking about value.
And make no mistake, this isn't some tiny little corner of the market. Forbes reports that private fintech companies raked in $53 billion in funding just last year. That is a tidal wave of cash betting that this new way of doing things is the future. I mean, just look at some of the newcomers on the Forbes FinTech 50 list. You've got companies like Rogo that were founded this year, or Hyperliquid from just last year. The speed of innovation is just mind-blowing. These aren't the old, stuffy institutions we're used to. They are disruptors, and they're built for speed and a whole new generation of investors.
So if fintech is the new arena, then artificial intelligence is its star gladiator. We're jumping headfirst into a time where technology doesn't just place trades for us, it's actually deciding what trades to place.
I want you to let that sink in. The traditional human analyst poring over spreadsheets, their role is being totally upended. Today, these incredibly complex AI models can scan millions of data points in the blink of an eye, and not just financial reports, but news articles, social media chatter, even satellite images, all to find patterns and opportunities a human being could never, ever spot.
So the big question is, does any of this actually work? Well, take a look at this number. According to investing.com, this is the total return of their Tech Titans AI-powered investment strategy. That is not a typo. Over 3,000%.
And just to put that into perspective, this chart here shows that same AI strategy against the S&P 500. Now, the market itself had a fantastic run, up over 382%. Not bad at all. But the AI strategy, it's playing a completely different game. The outperformance is it's absolutely jaw-dropping.
Okay, but hold on. Before you run off and hand all your savings to a robot, we need to have a serious reality check. Because with these kinds of insane returns comes incredible risk.
This new world is fast. It's exciting, but man, it can be brutally volatile.
This slide really lays out the two worlds perfectly. On one side, you have everything Buffett stood for: patience, fundamentals, predictability, the long game. And on the other side, the vibe economy, which is all about speed, sentiment, and constant disruption. These aren't just different strategies. Right now, in today's market, they're often polar opposites.
And even the experts are telling us to be careful. This quote from that Forbes article points out that even fintech valuations are sober when you compare them to the pure-play AI startups. What that really means is there's a ton of hype out there. And what does hype create? It creates bubbles. And we all know bubbles can be very, very dangerous.
And here's a number that gives you a sense of just how choppy these waters are. This is a recent value for the S&P 500 VIX index. You can think of it as the market's fear gauge. A number around 20 tells you there's a pretty significant amount of uncertainty and anxiety already priced into the market. The vibe economy might be a thrill on the way up, but it is almost never a smooth ride.
So, with Buffett's guiding voice now gone, and these algorithms spitting out data at the speed of light, where does that leave us? Where does that leave the modern investor? How do you even navigate this new world without getting completely wiped out?
Well, the biggest takeaway here is that it's not about choosing a side. The investor who succeeds in 2026 is going to need a whole new toolkit. It's about blending that timeless wisdom, patience, fundamentals with these powerful new AI tools. It's about managing your risk, being relentlessly curious and informed, and never ever thinking you're done learning.
And that really brings us to the final, critical question you have to ask yourself. As we're all standing here at this massive crossroads in financial history, you have to decide which path you're going to take. Are you going to trust the timeless principles of the oracle, or are you going to put your faith in the raw power of the algorithm? The future of your portfolio is probably going to depend on how you answer that question. Thanks for tuning in.